I'm going to have to pay taxes on my retirement account distributions anyway. So how will a reverse mortgage help me save taxes?
While it's most likely true that you'll have to pay taxes on your retirement income, a reverse mortgage may still allow you to pay less in taxes than you would otherwise. Let's look at an example of the kind of tax efficiency a reverse mortgage can provide. Imagine that you opened a reverse mortgage on your 62nd birthday so you would never have to make another mortgage payment as long as you lived in the home. Let's assume that your initial principal limit amount was $300K and that you had a small balance remaining on your home mortgage at the time, maybe $100K or so. That left you roughly $200K to draw upon. Let's assume you established a line of credit and made deposits from the line of credit into your checking account of about $1,500 each month. Keep in mind that even though you would accrue interest on these withdrawals, the line of credit will grow for life at that same rate of interest. 8 years later, you turn 70 because you have supplemented your income with your line of credit for the last 8 years and have not made a mortgage payment since you turned 62. You haven't had to draw much out of your retirement account. That has allowed your retirement assets to compound and grow to a much larger balance than they would have if you had been drawing on those assets and paying the additional taxes to live on. So far, you are doing pretty well. A few months later, you turn 70 and a half, and now you have a problem. The IRS requires that you start taking RMDs, required minimum distributions, from your retirement accounts beginning on the next April 1st. Distributions from retirement accounts, other than Roth IRAs, generally result in taxable income. The IRS calculates the amount of your RMD based on the account balance and your age. The higher your retirement account balance, the greater the amount of your required minimum distribution. Because you don't have a house payment, you probably don't need the additional income, but the IRS says you have to take it anyway, whether you need it or not, along with the tax hit that comes with it, or pay an additional 50% penalty. To make matters worse, this unavoidable increase in your taxable income happens at a time when you don't have as many deductions to offset the additional income. So what do you do? If you don't really need that money to live on, is there something smart you can do with it? Here's one solution. To reduce the impact of that inevitable tax hit, use the RMD money to pay down the balance on your reverse mortgage. Why? Because, keep in mind, any elective payment made on a reverse mortgage goes first to pay for the accrued mortgage insurance, then to the accrued interest. This benefits you in two ways. Any portion of your payment applied to interest, which is usually sizable, results in a tax deduction for you, with the potential to offset a significant portion of your taxable income. At the same time, any payment made towards either interest or principal increases the available amount available for you to draw at a future date. Let's take a closer look at how this could work. Let's say you accumulated $80K worth of deferred interest during that nearly 9-year period from your 62nd birthday to sometime after age 70 and a half of utilizing your line of credit and not making mortgage payments. You make an $80K payment, which goes towards paying the accrued interest. This gives you an $80K mortgage tax deduction to offset some of that RMD that just kicked in. Check with your CPA to make sure this would work for your situation. It gets even better. Let's assume that this year all you need is a $30K tax deduction to drop you into the next lower tax bracket. So your CPA gives you the go-ahead to write a check to pay $30K in deferred interest on or before December 31st. Then January comes, and it's your 50th wedding anniversary. You want to go big for this one. Simply request a withdrawal from your reverse mortgage line of credit, and within a week, that $30K is back in your checking account tax-free. Now that is tax efficiency. Awesome, isn't it?